Good morning, everybody. I hope you're doing well. Um, this is not a live video for you anyway. It's live for me while I'm doing it. But I appreciate your patience as I had an event. And anyway, here's our Tuesday, November 3rd, election day, right? So make sure that you get out there and vote. Maybe not. I'm afraid you might be voting differently than I do, and I don't want that. So I'm not going to discourage you. Anyway, today we're going to do a number of things, and I need to start my timer. Hang on a second. Needs to see my face. Probably didn't want to see my face. In any event, there we go. Sorry about that. I have some announcements to make, just like typical class period, and then I'll be finishing up the depreciation. I have one more comment to make about depreciation, and then we're gonna two more comments about depreciation. Then we're going to talk a little bit about labor burden, and we'll knock that out. We'll see how long all that takes. I'm going to shuffle things up a little bit from the syllabus because here we are in November and Thanksgiving is drawing nigh, and we need to prepare for the business plan project that you'll be involved in. So I have a presentation about that as well. I'm not sure that I can squeeze it into the class time, so I will likely, matter of fact, I will plan on it, prepare a different video for the business plan information, and that will be something that I'll post separately from the class video. Okay, so today is election day, and tomorrow we'll all be here. The world will still exist no matter what the outcome, and we'll just keep cranking on. Homework 7 is due at noon tomorrow, and that's your depreciation homework. It will prepare you for the quiz, which is coming up on Thursday. The last few minutes of class on Thursday, we will have the quiz 4, which is a depreciation quiz. I've decided to limit it just to depreciation, so you don't have to switch mental gears completely from, gee whiz, how do I enter these data into my books of account, to a depreciation issue. So anyway, so the depreciation homework is due tomorrow at noon, not midnight, but noon. Quiz 4 then is during class on Thursday, the 5th of November. And don't forget homework 5. Remember, it's homework 5 because it was assigned a long time ago. Homework 5 is the ratios for the publicly traded construction-oriented firm, and that is due next Wednesday. So you have a little over a week to finish that up, and I hope you haven't let any grass grow under your feet on that, because if you come up at the last second with a bunch of questions, it's going to be very difficult, particularly with my schedule next week, very difficult to get any sort of rapid response. So if you haven't started it, start it. So if you have questions, you can get them answered, get them resolved as soon as you can. Okay, that's all the announcements that I have for this class period. I want to dive in and talk about 2 last depreciation topics. And the first is this issue of what the book would describe in the glossary as a capital gain or a capital loss. Now, it actually, it's not a capital gain. But I'm going to describe this to you. I'm going to refer you to an example in the book, and that's pretty much all I'm going to do in this regard. It can be a complicated issue, but I'm going to refer you to example 5.7 in the textbook. It's on page 73 in the 4th edition of the text. And this refers to something I mentioned very briefly earlier, and that is the disposal of an asset. So when you have an asset and you're depreciating that asset over a period of time, you don't have to keep that asset for the recovery period or for hardly any length of time at all. You may make a decision to dispose of that asset, and dispose of is a general term that doesn't necessarily mean that you put it down the disposal. It doesn't mean that you put it in the junkyard. It could mean that you sell it. You might donate that equipment to a university. There are all sorts of things you can do. Disposing of an asset means that you relinquish ownership and it's no longer on your books of account. That's that. Now, when you dispose of an asset, there is a calculation that's made that relates the value that you obtained for that asset. Let's, for the sake of argument and without loss of generality, say that we will sell this asset for X. Dispose of this asset for X. X dollars come our way for the disposal of the asset. Well, perhaps the book value of that asset is Y. Let's let the book value be Y. Well, if X is greater than Y, that is, the disposal value is greater than the book value of that asset, then we have created a situation. And that situation is the difference between those two, X minus Y. The government would say, hey, I let you depreciate it down to Y, but now you're telling me its value is X, which is something greater than Y. So I want some of my tax break back. That is, some of that depreciation wasn't warranted. They're not angry. The government isn't angry. You haven't broken the law. You've done nothing wrong. It's just that the government gave you tax advantage, a tax break, a tax deduction, all the way down to Y, when in fact the value is X. So the government wants to tax X minus Y, that difference, that excess of the value over the current book value. The government will tax you on that amount. Currently, it's taxed at the ordinary tax rate. Now, the book uses the term for this, a capital gain. It is not a capital gain. The book, I realize this is a technical error, but it is an error. You've heard of capital gains. I'm going to talk about those here in just a moment. But what you have there when X is greater than Y, that's called a depreciation recapture. And that is that the government wants to recapture some of the depreciation that they previously allowed that got you down to Y, the book value of that asset down to Y. So it's very simple. You take X minus Y, you take that number, and that is counted as income, and you're taxed on it. Now, it's only the difference that's counted as income. It's not the entire X. X is not income. X minus Y, that's the income that you get. That's the depreciation recapture income that's then taxed. Similarly, X may be less than Y. You may dispose of that asset for a value that's less than the current book value, Y. So if X minus Y is negative, that's called a capital loss. And once again, nobody's angry. You haven't broken a law. No big deal. It's just that the IRS, while they want their tax money for a gain, for a depreciation recapture gain, they want to also give you this break if you haven't allowed enough depreciation. So what they will do essentially, if X is less than Y, X minus Y is negative, they will take that negative amount as, you can take that as an immediate depreciation or an immediate expense on that asset. So you get the tax break on that extra amount. And that's called a capital loss. And the capital loss is when you sell an asset for less than the book value. So that's kind of all. That's more than is squeezed into that example, actually. And to the best of my knowledge, that's the only place I can find reference to what the book calls capital gains and capital losses, except in the glossary where it uses those terms and just tells you what they are. Kind of. Again, so you can use the term capital gain for this class. The textbook uses it. I squirm when I use that term, because now briefly, what is a capital gain? A capital gain is when you dispose of an asset for more than the purchase price. So it's not more than the current book value, it's more than the purchase price. So for example, where do you see capital gains? Well, you see capital gains when people sell homes, perhaps. If you buy a house for $300,000 and you sell it for $350,000, that $50,000 more than you sell it, more than you bought it for, that's a capital gain. You've made money totally on that asset. Also, stocks and bonds. If you buy a stock and you pay $12 per share and you sell it at $15 per share, well, you have $3 per share of capital gain on that stock. And you pay taxes on that. And actually the tax rate on a true capital gain, currently, the tax rate is different than it is on ordinary income. So your tax on ordinary income may be 22%. Your tax on a capital gain may be 15%. This is not a tax class, so I won't go into that any more deeply, other than you should recognize that true capital gains, not what we're talking about, not this depreciation recapture concept. True capital gains currently are taxed at a different rate than ordinary income. The depreciation recapture and the capital loss that we're talking about in class here and in the textbook, those are taxed at the ordinary income rate, or they are expenses that affect the taxes at ordinary income rates. Okay, so that's the asset disposal. There's a question on the homework that's due tomorrow, and I think it's question 24. And so you should know that to calculate a capital gain or loss, capital gain or loss, you need to compare the sales price to the current book value of that asset. Now, it turns out there's all sorts of extra rules related to that. And if you sell it before the recovery period, there's some depreciation games that get played. So it's more complicated than this. But for us, just recognizing that and make that simple calculation, that's all we need to worry about with respect to that and that question on the homework. Okay. Now, as you may know, there's the last 8 Well, in 2008 began the turmoil. So you all were very young, and there were some economic difficulties, uh, which, you know, that's the way it is. That happens. We go through cycles, things like that. This was caused, you know, depending on your political leanings, these things you either blame the banks or blame the government. I'm not going to get into the blame thing, but that started a lot of economic issues, and then we finally had some some presidents are always talking about, or even legislators are talking about revamping the tax code, or rebuilding or trashing and you know, tax code is discussed a lot. Very few changes actually ever get made. There were some changes that were made in the Tax Act in 2017. There was a lot of tax activities and updates and changes, and you know, uh, all in all, reasonably little change. But there were some changes in depreciation. That was one of the big deals. And I will say, on the corporate side, as you can see, you know, corporate activity until this COVID thing hit was very strong, and even during COVID is surprisingly strong. And the kickoff for some of this, you know, I'm not an expert, but the kickoff for some of this, I firmly believe, was the changes in depreciation and the treatment of that here in the short term. These are not permanent changes, and we're not going to talk about these changes in detail. I just want to talk about one particular element that that would be very helpful to very small businesses, such as you might have, and these will still be in place for the next few years, changing each year perhaps. And I have a slide for that. So let's go to that slide and look. Here we are in our, this is the same set of slides we've been looking at lately, our depreciation slides. And here is the slide on section 179. These are the 2019 numbers. And so here's the description here. Section 179 of the tax deduction is this is new federal law that will allow a business to deduct all or part of the purchase price, all or part of P, for certain equipment, certain types of equipment. Now, this is important because, you know, when you buy a piece of equipment, you whether large or small, right? I mean, you buy a very big saw that you're going to use on site, transport and put it on site and use that saw there, or a dozer or whatever. When those cost you money, right? I mean, when you buy those, it may be on an invoice, but you're paying cash. Eventually, you are paying cash for those items. And if it's a deductible item, you cannot deduct the cash that you pay for that item from your income because you're depreciating it. So when you depreciate it, that spreads the cost of that asset out over time, right? And so you're spreading this out over time. You're not counting it at one time. You can't count it at one time and then depreciate it. That's not the way it works, right? You get to write off the expense of that asset, but with depreciation, you do it over time. With some that are not depreciable, that is, that you can expense them, remember that term, you can expense them in 1 year. You can expense them so that whatever you paid, let's say $80,000 for a new saw, you get to take that and use that as an expense. So it's an expense on your income statement, and it just comes right off of your income. So we have expensing assets and we have depreciating assets. Well, Section 179 says that you get a first year write-off of $1 million. So something that would normally be depreciable, you get to actually expense that. And there's an example calculation on this slide. And that is, so here's, you buy equipment of $1.15 million. You get a first year write-off of $1 million of that. And it turns out there's a bonus depreciation that you can take the rest of that, which essentially means you have no depreciation, but you can expense the whole shooting match, the whole kit and caboodle, as we used to say, of the $1.15 million. And because of that, if you're taking all of that as an expense, if you take that times your tax rate, you're saving essentially. Now, remember, we talked about depreciation not being a cash flow. Tax is a cash flow, right? So you're saving $402,000 by being able to do this. If you had to depreciate the entire 1.15 million, you would get some depreciation in the first year, but nowhere near the total. So now I didn't show you what that might be if you depreciated it, but the cash savings from just the write-off is 402,000. So talk about stimulating economic activity. You buy $1.15 million worth of equipment, and you're essentially paying $748,000 for that $1.15 million because of the tax break that you get. And that's a and it says here, assuming a 35% tax bracket. Yeah, corporations, yep, 35%. Doesn't take long to get there. So that's a heck of a nice feature. Now, what that does is, all the depreciation we just talked about in chapter 5. So that means you wouldn't apply any of that in this case. That doesn't make everything we talked about with respect to depreciation useless. Matter of fact, it's very useful because not all equipment qualifies, but everything you can do here. Pardon me, there is a spending cap on equipment purchases. In 2019, it was $2.5 million. It doesn't mean you can't spend more than that. It means that only that much is eligible for Section 179 tax treatment. I wanted to say something else. It just, my brittle brain just zipped right through there. Anyway, this does fade out. This doesn't last forever. I believe that, I can't remember, it's in the textbook, I'm sure. I can't remember exactly when this expires, but every year there's a small adjustment, and then it expires in the mid 20s, 2025 or 6, maybe something, 7. This will go away. It's planned to go away. So anyway, keep this in mind. This is important to know. I'm not going to make you do any calculations about this. This is getting, this can get pretty deep in accounting, depreciation, jargon, and trickery. That's probably not the right word. But so anyway, here it is, and I give it to you for your knowledge and knowledge base. I might ask you that this exists, if this exists, and generally what it allows you to do. Big picture, what's on this slide, but that's it. That's all you need. Okay, now we're going to switch gears just a little bit, and we're going to look at the labor burden. Sorry, just want to make sure I'm not overspending my welcome. We're going to look at chapter 8, some chapter 8 information here. And, you know, chapters 7, 8, 9, cash flows, things like that. We're going to be touching on a lot of those. And this labor burden, chapter 8, determining labor burden, is something that is important to understand. Once again, it can get very complicated, and you will see how expensive labor turns out to be in this. We've mentioned some of these things in the past in this class. I've dabbled around and danced around a lot of labor related expenses and issues, and here we formalize those just a little bit. Now, we've talked about, you know, all the different resources we have as a construction entity, and how we've talked about money flowing. We've talked about billing and invoicing and paying those things. We've talked about entering those in the books of account. We've talked about net income and expenses. We've talked a little bit about equipment, and we've talked about equipment accounts, depreciation of equipment over time. And then, you know, of course, you have other tools, right? You have construction-oriented tools, you have office-oriented tools, a lot of those that show up in your books of account as well, and you have to make decisions about what to purchase, why to purchase, when to purchase, things like that. And we have a lot of people. In general, construction is labor intensive. It requires a lot of people and a lot of time in order to get things done. And we're going to talk about people here now for just a little bit. There are a lot of things to consider with people, and the cost that you will incur for people. You have wages. We'll talk about those. Cash, matter of fact, we're going to talk about all these to some extent. Cash equivalents and allowances. Sometimes you would provide a benefit to somebody, but you decide you'll give them cash instead of that benefit to use for that benefit. More on that later. Payroll taxes. We've talked about payroll taxes, Medicare, Social Security, and the like. We'll talk a little bit more detail about those today. Unemployment insurance, either through the Federal Unemployment Tax Act, FUTA, or state unemployment tax acts, SUTA. And unemployment insurance is something that you provide through taxes that you pay. Workers' comp for injury, and then general liability insurance. Talk a little bit more about those that you need to have. You know, I can't remember if I've said this in this class or not, right? The 3 fundamentals with money: earn, protect, grow, right? That's how you earn your money. The first thing you should consider is protecting your money against big losses, like, you know, that's why you have car insurance and liability insurance to protect you in case something goes wrong somewhere. Somebody slips and falls on your property and they sue you for $1 million. Well, there goes all the money you earned unless you've protected it. So earn, protect, and then grow, and that's investments and things like that. So insurance is a protect stuff. Then retirement. Are you going to provide retirement opportunities for your employees or yourself? You know, it depends on how big you are, how many employees you have. Union payments in that situation where you have unionized labor, you may be making payments to unions on behalf of employees. And Vacation. What about vacation and sick time? Are you going to provide, do you provide those things for your employees, and what those may cost you? So we're going to talk about all these things at a surface level. But remember, when you hire somebody as an employee, you're going to be facing all of these issues. So you want to tie this all up in a bow before you go out and recruit your first employee. Need a plan for all of these things, right? Because the hourly cost of an employee is not what you pay them, right? Your hourly cost really is how much they cost you, not how much you pay them necessarily, how much they cost you divided by the hours that they work. And the hours that they work do not include vacation time and sick leave and all that kind of stuff. It's the hours, the productive hours that are actually worked. But you do incorporate the vacation time and the sick time and all those things. You incorporate those into the cost. That is what they cost you on an hourly basis. It's included in there. So all of these things need to be included at some level. What kind of employee will they be? Will they be an hourly employee, or will they be salaried? Will you have salaried employees? That is, employees that are called, maybe in many places are called exempt employees. That is, they don't earn overtime. You don't pay them overtime. They work for you, and they work to get the job done. There may be an expectation of 40 hours a week, but you don't pay them overtime if they work 50 hours a week, right? They work to get the job done. Or hourly employees, where you would pay them overtime. This the Davis-Bacon Act. You ought to go out there and look at the Davis-Bacon Act. Been around a long time. Employment Act. How much do you pay your employees? Well, there's lots of ways to determine what that is. You have market rates, right? You need to do a study for the market in your area, for the skill set for which you're hiring these employees, and look at the market, and you're going to have to pay the market. Likely you may want to challenge the market on the low side if you wish to see if you can get reasonable employees. You may want to pay your employees above the market because you want the cream of the crop of that particular kind of employee, right? And you're willing to pay them a little bit more because you perceive that doing so will improve the quality of the work. Maybe so, maybe not. I'm not a personnel expert, but those are the decisions that get made. The union, a local union, can provide you with the going rate and the rate that you would pay for certain types of employees. And then, of course, Davis-Bacon, you've got a minimum wage that you have to make sure that you pay on particular jobs. If it's a government job, you're tied to certain levels of wages. And those are legal details that mean that you need to have. Once again, if you start off with your own company, you need to surround yourself with experts. They may not be on your direct payroll. You may not hire them, but you need to have an arrangement with legal advice. You need to have an arrangement with insurance advice. You need to have a legal arrangement with accounting advice. So you need all of these things, and this is where they can help you considerably. Okay. Burden. What is burden? Burden includes all the costs that you pay, the entire cost of that employee or employees to you, which is the wages plus, right? Plus the burden, plus everything, fringe benefits, and the like. Now there can be cash benefits, cash equivalents, In lieu of benefits, you may pay someone, instead of reimbursing for automobile expenses, you may give someone or allow them use of a company car, or you may give them a vehicle allowance, right? 100 or 200 or $300 a month, for example. I've got a buddy working for a company who gets just told me the other day, he gets 19 cents a mile for fuel. So that's a reimbursable that goes into a general overhead account, and the actuals are, taken care of that way. But he also gets an allowance, $500 per month, vehicle allowance. So because he drives a considerable amount for work, and they pay that for him. And perhaps you could have tool allowances, right? If on the job you can they can provide tools, or provide money for tools. Now, these are subject to taxes just like wages. So you're still providing this benefit, and it's cash equivalents. So you will be, these are subject to taxes. And so an employee needs to make sure, since they're getting this benefit, they need to then keep track of their expenses so they can do their own taxes properly, right? So my buddy with the vehicle allowance needs to keep track of what he spends on his vehicle so that he can offset that extra, that allowance income with his own expenses. That's another story for employees to manage their taxes. Social Security and Medicare, FICA, we've talked about this a little bit. A total of 7.65% of the employees' wages are used. So that's an extra tax. So that comes out of the employees' wages, right? They get, let's say they get $1,000. Well, what would, shoot, I don't know what that is. 7650 is out of that $1,000 gets sucked out and goes to Social Security and Medicare payments. And now, interestingly enough, so you also, that's $76.50, you also will pay, right? The total, what is it, 7.65 times 2, 15.3 or something like that. Don't trust me on that math. Percent is what the total cost is. The employee pays half and you pay half, right? So you'll be paying Social Security and Medicare for your employees as well. Employee payments for medical insurance may be exempt. I don't know. I don't have a clue. It might be. It depends. These things are fluid quite often. Now, this Social Security, the 6.2%, the largest portion of these payments is for Social Security, and there is a limit, and that limit is $137,700 in 2020. So once an employee's wages get that high, then the 6.2% is not charged above that. So, after that, that tax goes away. Still pay Medicare, the 1.45%, but the 6.2 goes away. Now, know that this 137.7 grows, and it grows fast. It was $106,000 in 2011, as best I can recall. So it's gone up a lot. This limit continues to go up, and it's again, it's government's way to get more tax money in, because remember, you don't have an account at the in Washington D.C. for Social Security and Medicare. You do not have an account. This all just gets paid. They're transfer payments, and what you pay in there actually comes to me. So I'm excited about that. But you can read the details sometime. We don't need to talk about it in here. Just know that that is an expense that you will incur as an employer, and is part of the burden, right? It's not the portion that the employer pays is nothing that shows up on the check, or on the what do they call it, salary advice or something. Anyway, it doesn't show up on the employee side. Now, unemployment insurance. Okay, so we got 6% for FUTA, and on the first $7,000 of each employment's wages. So again, back in 2011, it was 6.2%. I need to check and see exactly what that is for 2020. And but you can have up to a 5.4% credit if you have employees covered by SUTA, state unemployment, or well, you have to pay the state on time. But so the minimum, if you get this credit, the minimum can be 0.6%. So just realize here, remember, all of these are on top of other taxes you're paying. So just kind of keep that in mind. It'll be a separate accounting for these particular expenses for employees. So you do have unemployment insurance. SUTA does vary by state. So every state has their own state unemployment tax act, and your rates are, the state is going to look at your rates, determine your rates based on your history and claims made by those who have worked for you in the past. So when you start with a clean slate and you start without any history there, the state has a standard rate that they will begin to apply, and it varies from state to state. And so you can see a little bit about how they calculate historical data. Workers' comp. So especially in the construction industry, workers' comp is incredibly important, and workers' comp is typically expressed as a dollar value per $100 in wages, and so there is an experience modifier that gets applied. Once again, they'll come in and they'll look at your record, and if you've been a really safe place, your insurance rates are going to reflect that. So you want to be very conscientious about safety in the workplace, and I know the Myers-Lawson School of Construction is very focused on safety in the workplace. You still need insurance. It doesn't matter how safe you think you are. You still need insurance to protect yourself and to protect your employees. If you care for your employees, as I'm sure you will, you want to make sure that they're properly protected, and workers' comp is certainly one way to do that. You also need to think about general liability insurance. Same way, it's expressed as the same way. It does vary. So based on the employees you have, the workers you have, what they're doing, the kind of jobs you're doing, this general liability insurance, the expense of that is going to vary. And notice that this does cover three major things: bodily injury, property damage, and lawsuits. And you might be thinking, well, what would happen? What is this? Well, it could be somebody visiting the job site who gets injured. Maybe you have somebody with a nail gun and they pick it up and accidentally shoots off and nails somebody's car, or shoot somebody in the leg. I don't know. Those would be general liability sorts of instances that you need to be protected for. By the way, I will say, just in passing, from a personal standpoint, you need to have general liability insurance as well. When you start earning money, when you get out in the workplace and you start earning money, regardless of what you may or may not have, you need general liability insurance. Things can happen in life and you need to be protected. It's not expensive. It is an expense, but it's not expensive. And the less you have to protect, the less expensive it is. But please, on a personal basis, make sure you have this as well. But it's really important. If you're running a business, your business can go away overnight with some sort of damage that happens through lawsuits and legal costs. So make sure you have this, and it goes in there as part of the burden, right? Okay, regular insurance, health insurance, dental, vision, all those sorts of insurance issues that you would want or don't have to, but typically are provided for certainly salaried workers. Wage workers, sometimes yes, sometimes no. You need to determine that. But all of those sorts of insurance expenses that you're going to cover, maybe the employee pays some, maybe you pay some. But again, you need to determine ahead of time, with advice from professionals, what you can provide, what you should provide. And it's a competitive advantage to be providing these benefits as well, right? Retirement. What about retirement plans? For salaried employees, they will expect a retirement plan. Wage workers typically don't expect it, but you could still provide it. You could put some limits on it. You could provide all sorts of conditions on it before participation in a plan. But certainly, they're very valuable to salaried employees, and most people at a salary level will not work somewhere where there is not some retirement plan that they can participate in. Now, a 401k is one that employees contribute to, as well as employers contribute to those. It often requires a match. So the employee puts some in, and the employer will match it to some extent. And there are limits put on these. It's gotten to where you may have heard of pension plans. Pension, or what's called a defined benefit plan. And that is, the benefit you will receive upon retirement is defined. 401k is a defined contribution plan. That is, what you get out at the back end isn't defined, but what you put in is defined. And so it's up to the employee, to a large extent, to manage those funds so that they grow appropriately and are available at retirement. That's why the little sign here, invest wisely. You get to, the employee gets to be the investor in that case. Okay, so you have that expense going on. And finally, unions. So you may provide the union dues for your employees. You may pay those directly. You may do some sharing of those union dues. there's all sorts of ways with respect to union payments that you would participate in those sorts of plans. And so all of these things we just kind of run through very briefly and very quickly. All of those will tell us, sorry, looking at my timer here, all of those go together to determine the annual cost, right? The cost to the employer, that's you, for each employee for a year. If you look at all those costs, so we're talking about the cash equivalents, cash in lieu of benefits, we're talking about insurance, FUTA, SUTA, FICA, workers' comp, general liability insurance, 401k, retirement benefits, union payments, all of these expenses that you would incur go into the annual cost. So if you take the annual cost and then divide it by the total wages for an employee minus wages that you pay them on time off and minus any bonuses that you've paid them, right? So, and do that ratio and subtract 1, you get the markup, the percent. This will be a decimal, typically. Less than 1, typically, may not be in all cases. Less than 1, which is a markup for employees. So if you figure you're going to have, your employees' wages are X, you've got this markup of gosh, I don't want to use X and Y again. Let's use A and B. Employee wage A, and your markup is B. So 1 plus B times A is going to be how much you would charge to the contract, right, for that particular employee, charge to the job per hour for that particular employee. Okay, so that's labor burden stuff, and it's not pretty. We didn't do any calculations there. I'm not going to ask you to do any calculations of that. So you can look at chapter 8. If you look back there, actually forward there, chapter 8, you'll see that there are some calculations that go on. I'm figuring that you all can take a number and multiply it by 1.062 and find out what the Social Security cost is. I'm thinking you all have that down. I do want to briefly mention figure 8.1 in chapter 8, which is on my page 115, and it's called General Decision, and this has an example of different employee positions and their rates and their fringes. So you'll notice a sprinkler fitter for fire sprinklers, the fringes are a little more than 50%. It's the rates $32.14 and the fringes are $17.77. That's interesting. And then you look at a carpenter whose rates are $21 and fringes are $3.20. So you would want to know here, it'd be interesting to know, okay, so why are the fringes so much less? What are we not including in the fringes here for the poor carpenter that are going into the fringes for the sprinkler fitter? And anyway, you can see, a lot of these, the day labor type labor have no fringes because they get no benefits. They're just paid an hourly wage, and this is it. They get paid that wage, and they get a check and they go home. They don't get benefits. Now, if they're truly an employee, you can hire them They're not an employee, they're an independent contractor, if you will. And then you issue what's called a 1099 afterward, which is, hey, we paid this individual this much money this year. And we're not paying Social Security and we're not paying all these other things because they're not an employee. We gave them this much money this year to do some work. And that's probably what some of these day labor arrangements are gonna be. Okay, and so then in chapter 8, there is just a summary of what I've talked about here today. So we're about 55 minutes, or well, actually about 57 minutes maybe in, and I am going to stop this video here. The other discussion on the business plan will be in a separate video, which will be posted very soon. But I'll mention this in class on Thursday. I want to get us started thinking about the business plan. I'm a little ahead of the syllabus on this, but I feel like I'm behind. I feel like this is something we should be talking about. So we're going to. And this is for you to develop your business plan, and there are several components, aspects of that. And so I'll post this other video to address those issues, and I'll post it very soon. I hope you had a good Tuesday. I hope you have a good Tuesday. And don't forget the homework due Wednesday at noon. And then we'll be back ready for class 8 a.m. on Thursday, the 5th of November, to pick up pretty much where we left off, moving on in the syllabus. And don't forget that the quiz will be the last 20 minutes of class on Thursday. All righty. You have a good